Investing is not just a game of fair valuations. It's not just about figuring out where a technology or a company might go. It's also a game of attention. When there's a lot of attention on an asset, there will be a lot of buyers, and that will drive up the price. Now, there is a lot of attention on the Virtuals protocol. Have a look at this. This is the recently published video on Virtuals protocol on this channel 5 days ago, and the video outperformed the average video. The average video is in gray and the Virtual protocol video is in blue. Most of the traffic comes directly from search, and it is not surprising because Virtuals protocol had been one of the top performers in the last month. Now, where does this performance come from? Who's buying, who's selling here? I've published several videos on Virtuals protocol on this channel. Feel free to subscribe over here not to miss any in the future. But here's basically what's going on in the last few days. There is a lot of short interest on the token. In other words, on the perpetual futures market, on the market where people bet on the price, we see now more shorts than long. So the majority of people are currently betting on falling prices. The shorts have to pay the longs. It now costs money to bet on falling prices, which usually for most tokens is not the case. Normally the longs have to pay the shorts because we get additional leverage on the perpetual futures market. Not so for virtuals though. As there are more and more people betting on falling prices, it costs quite a lot of money to have that position open. And a situation like this invites the market makers, it invites the manipulators, it invites the people to buy the token, because now taking on the long side of the trade gives direct returns, but also as a side benefit, it can help potentially liquidate people. And that then generates liquidation fees for those market makers. Just have a look at how much the price correlates with the open interest on the perpetual futures market. When there's a lot of open interest, the price tends to be high. When there is less open interest, the price tends to be low. And so as more and more people speculate on the virtual price, the spot market reflects that speculation as well. But let's have a look at the on-chain metrics. What's happening long term? What's happening, for example, since beginning of the year? There had been a shift actually since beginning of the year. There are three versions of the token. There's one on base. So this is where Virtual was launched with 350,000 holders. There's another version on Ethereum with 28,000 holders. And a third version on Solana with 16 or 17,000 holders. Here are charts I like to look at for pretty much any token on any chain. And it's the number of retail investors versus whale investors. The way we make this distinction is by looking at the minimum holding thresholds. How many tokens are in a particular wallet? To be counted for the chart on the left, a wallet has to hold at least 1,000 virtual tokens. So that's more than $1,000. To be counted in the middle, it's 10,000 tokens. To be counted on the right, it's 100,000 tokens. So the wallets on the right are 100 times more important than the wallets on the left. In other words, 300 whale wallets correspond to roughly 30,000 retail wallets. So the retail wallets don't really make that much price discovery, right? They're only 1/3 of holdings compared to what the whales are holding. And those are just minimum holding thresholds. So there are few whales that hold much more than just 100,000 tokens. Here are the same numbers for the Ethereum chain, and here are the same numbers for Solana. So for Solana, we can already say that the whales really don't matter that much. We don't have that many wallets, just 15. And for Ethereum, we can see that over time, there's more and more distribution happening, not too much buying, but there is some dynamic on base. On base, we saw all of that accumulation by the whales, and that stopped at the beginning of January of this year. This is when the whales, even on the base chain, tended to sell. Now let's keep that in mind, and let's have a look at potential upside versus potential downside relative to Bitcoin. So let's start with the upside. Here are the largest AI agent launch pads. And there is a case to be made that maybe Fetch AI or Artificial Superintelligence Alliance is working on an AI agent launch pad as well. They've got a market cap of 1.7 billion. So this would give us an upside potential for Virtuals protocol of roughly 60%. But it can be a bit more generous. We can look at artificial intelligence tokens in general. And then the best comparison is probably BitTensor, which would bring us to a 3x from here. So a 200% gain. 200% outperformance versus the rest of crypto. That's probably the realistic upside. Everything afterwards is of course quite hard, then the air is getting thinner. And so have a look at this. This is Virtual's protocol relative to Bitcoin. So a relative valuation chart on a logarithmic scale, not on a linear scale. And over here, interestingly enough, from the current price to the prior top, we have an appreciation of roughly 200%. So we already saw with the comparison to other AI tokens, we also see in this chart. The upside is probably 200%. But then, according to this chart, the downside might be 66%. Now we still remember when the whales started selling, right? This was at the beginning of the year. And that's also what we see in this chart. Since beginning of the year, Virtual's protocol sold off. It underperformed Bitcoin by 88%. Now, interestingly enough, it's now going up again. But the whales are not buying. So what's going on? Again, I think it's the leverage in the market. It's the short-term bets on the price. It's the perpetual futures. Because now so many people bet on falling prices of Virtual, the market makers are incentivized to buy up more of the supply. And so this whole rally is all just short-term leverage driven. How high could we go? Are we going to see another 3x or 200% increase? Maybe, but what I'm actually looking at is this here. It's the financing costs. Once those become somewhat neutral again, once we are slightly green in the funding rate, that's when I'm interested in shorting. If the shorting becomes less of a popular trade, then I want to bet on falling prices. I don't think it's that great to bet on rising prices right now. Because again, the smart money is not accumulating. The smart money is just holding. It's a stupid money. It's a small retail investor that gets attracted by this rally. Now, why am I saying that this is the stupid money and this is the smart money? It's because crypto is a game of both luck, but also of skill. And the more skill we have, the more we play the game, the higher our expected value per bet is, and the more the capital will concentrate towards us. So the people that already have a lot of money to play with, they probably on average did the right calls in the past. And so they've got a higher likelihood of being skilled as well, of being the smart money. And so when I don't see the smart money getting in, why would I get in? Just because of short-term leverage that might deflate at any time. There is a chance of a potential short squeeze, as in more people might actually enter the short position, and then it becomes even more attractive for the market manipulators to push the price higher. And the reason why shorting could become more attractive is the tokenomics. Check this out. This is Tokenomics AI, the virtual protocol. Apparently, there is a potential unlock happening at the 1st of June of this year. The supply could increase by 50%, and many people might be betting on falling prices because of that unlock. If that happens, and if the funding rate gets very, very negative again, then of course I will not short. I only want to bet on falling prices when it's not a popular trade. I don't want to be with the masses. I want to be contrarian. Yes, virtual protocol could go higher from here, a maximum of 200%. I'm not speculating on that. I'm waiting for the financing costs of shorting to come down, and I'm waiting for clarity around that unlock. Now, in October of 2023, the market flipped. The market turned from bear to bull. The market saw inflows from traditional finance. And we can see this in this chart. This is the stablecoin market cap. So it shows how many dollars in the fiat system are deposited somewhere with a custodian, say with Tether or with Circle, and what equivalent has been minted as stablecoins on chain. And from May of 2022 to October of 2023, we actually saw a contraction of the market. So money was flowing out of crypto. People were turning back to TradFi. People were withdrawing their money. But that then changed in October of 2023. Since then, we see more people depositing than withdrawing from the crypto ecosystem. And surprise, surprise, this is of course also an impact on crypto prices. When money is flowing in, crypto prices tend to go up. And that is what we see with this chart at the bottom. This is the Bitcoin price. So when money comes into the market, Bitcoin goes up, and that is with a leverage effect. So Bitcoin appreciated by 260% since the beginning of October, while the stablecoin market cap went up by only 85%. Now still, there is a lot of volatility. What causes a price drop like this of 26% while there's actually money flowing into the system? The answer is swapping activity. So it's not just people depositing their money into the system and then wait and invest for the long term. Most people in crypto trade actively. And whenever people move from stablecoins to risk on assets like Bitcoin or altcoins, the prices go up and vice versa. So there's money flowing in and out, and there is swapping activity, people getting risk on and risk off. Now we can use that data because we can have a look at how much of the entire cryptocurrency market cap is currently in stablecoins. When most people have swapped into stablecoins, the stablecoin dominance, so the percent of all of crypto that's in stablecoins, that's pretty high. When a lot of people have deployed their stablecoins, then the stablecoin dominance is low and the crypto prices are high. So check this out. This is the stablecoin dominance, and this is much more volatile than the stablecoin market cap. And at the peak, 19% of all of cryptocurrency's market cap was just stablecoins. So that's when people are very much risk off. And that's then also when the Bitcoin price tends to be low. As stablecoins get deployed into risk-on assets again, the Bitcoin price tends to go up. Now, in the last 1.5 years, we tended to trade in a range. So that's between 9% stablecoin dominance to 5% stablecoin dominance. And if this is now coming back down again, as we have seen in the last few days, then crypto prices will go up. Let's work with the assumption that we see the exact same development of people deploying their stablecoins again as we saw in November of 2024. So let's overlay this. If we take this time frame and we look at the Bitcoin price development during that time, then we can overlay this to the price today. And we're getting to a potential upside of somewhere between $130,000 to maybe even $150,000 per BTC. And so this is, I think, the most likely scenario. I think most people have this backwards. There are too many comparisons made with traditional finance and the crypto ecosystem, as in when the money supply is going up or when the Federal Reserve is lowering interest rates, that's when money is loose and that's when crypto prices should go up. But I don't think the link is that strong. I think the link is much stronger for how much money is currently on the sidelines already within crypto. We know that the crypto ecosystem as a whole is expanding, right? The stablecoin market cap is going up, and that obviously matters. And at the same time, we also see that a lot of that stablecoin money is not yet deployed, but is ready to get deployed. And so if we work with that scenario, if we say, okay, a lot of that money might get deployed if times get a bit brighter, should we just go now and buy all kinds of random altcoins? I am not so sure, because here's the counter story to all of this. The Bitcoin dominance continues to go up. So as a fraction of all of crypto, Bitcoin becomes more and more important. Bitcoin tends to outperform most other assets. And we only saw an altcoin rally when Bitcoin dominance was close to 70%. So when only 30% of the cryptocurrency market cap was in the alts, that's when the alts were cheap enough to subsequently make a rally. And we are not yet there. So just building a portfolio of altcoins is probably not going to cut it just yet. Here is what I'm doing instead. I'm looking at what are other influencers and other heavyweights buying. So we track various important wallets and we see, for example, how the Pepecoin team or the Base AI team is accumulating the KEK token. And that's happening at a very small market cap, only 3.2 million. We got notifications for all of those purchases, and though the price just continues rising, we still need an edge in this market. We can't just buy any random altcoin, but the market is expanding. It does make sense to take some risk on bets now. Now, since crypto cannot create money out of thin air, it's still a player versus player game. And so if you follow the insiders, if you follow the people that traded well in the past, we have an edge. For example, over here, we've got 33 wallets that we track by the Crypto Banter group. They've got 1.16 million subscribers on YouTube. Or we are tracking 12 wallets by Alex Becker. He's got 1.6 million subscribers. Or check this out, Brian Young. We have 5 of his wallets and he's got 2 million subscribers. So there are 2 components to this. First, those influencers tend to get information relatively fast. They tend to beat the market. But secondly, they might also have an impact on the market. So when somebody with 2 million subscribers talks about a small cap cryptocurrency, of course, some of the followers will buy the token, which then pushes up the price. And so with all of those wallets that we are tracking, we get various signals. Who's buying and selling what at what point in time. And while it's nice that the market is expanding, it's still a winner takes most market. So returns are very much concentrated in just a few assets. There are mostly losers in this market and a few winners that take it all. Just have a look at the top 100 cryptocurrencies in the last year, right? There are some tokens that perform phenomenally and a lot of them that are just losing. So just diversifying does make sense. If we just build a portfolio of many different altcoins and we don't trade actively, then we are underperforming Bitcoin because Bitcoin dominance continues to rise. Instead, what we need to do is we need to find ways to buy things such as virtual very early. And this is where we come back to Brian Young. We got a signal of Brian Young buying into the virtual token, and that was at 7 cents. So that was on the 21st of March of last year. Our community got excited and bought in. And of course, the rest is history, right? Now we are at $1.75. And so this is my strategy in this market. The market is expanding, people are making profit, but still returns are concentrated in a few winners. And we have to have a way to identify those winners. And we don't have to be the best at this, right? We just need to know who are the best and we have to find their wallets. And of course, this is not public information. And so we have to do on-chain analytics to find the wallets. And so of course there is the influencer trade channel with all of those signals, but there's also a tutorial course on how to find different wallets. So we use related trades, we use official NFT transactions, we try to figure out ways through deposit addresses on centralized exchanges, etc. to get new wallets that we then actively track with this automated bot in the channel. And since the community is learning how to find new wallets, we also have a dedicated wallet research channel. So this is then where our 500 members look for new signs for influencer wallets. And once the moderators have confirmed those wallets, they get added to our tracking. For example, here, right, we've got Crypto Gains that suddenly out of nowhere was talking about the Champ token. And of course, we knew about this because we saw the purchase alerts before in our tracking. And so by tracking the insider wallets, we become insiders as well. Not of course in the legal sense, because all the data on the blockchain is 100% official and transparent, but we do have an edge over other market participants because most people don't go through all of that effort. And so it's not necessarily just about buying one asset and finding the winner and holding it long term like virtual. It's also about shorter term trades. And so the community, of course, shares the winning trades as well over here. Just have a look. If you add some leverage to the game, you can make quite nice gains in a short period of time as well. So feel free to check it out. It's currently $125 per month. If your crypto portfolio is not just $500, but rather 5,000, then it's probably going to worth it for you, especially in this current market. If it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in Premium. Cheers.